This topic is about the functions of the financial system, from learning module, market organization, and structure. Information-motivated trader is someone who uses special information or analysis to make trades that they hope will make extra profit. Maria is using special data, satellite images, to make trades that she hopes will make extra profit. This matches information-motivated trader. Hedger is someone who uses trades to reduce risk, not to make extra profit. Maria is not reducing risk. Investor is someone who buys stocks to hold them for a long time, expecting them to go up in value. Maria is not just buying and holding stocks for a long time. Investor is someone who puts money into things like stocks or bonds to make money over a long time. Anya is putting money into stocks for a long time to make money. Hedger is someone who uses trades to protect against losses, not to make extra money. Anya is not trying to protect against losses. Information-motivated trader is someone who uses special information or tricks to make quick profits from trades. Anya is not using special information or tricks for quick profits. Aggregate is using a contract to protect themselves from losing money if wheat prices drop. It matches Hedger. Speculator is someone who takes big risks to try to make a lot of money from price changes. Aggregate is not trying to make a lot of money from price changes. Aggregate is not using a special information for quick profits, not an information-motivated trader. Option C is about making sure all investors always get more money back than they put in, even after considering inflation. The financial system doesn't guarantee this. Option A is about moving risk from people who don't want it to people who do. The financial system does this through things like insurance and investments. Option B is about finding the right interest rate that matches how much people save with how much people borrow. The financial system helps set this rate. Well-functioning financial system with no government intervention means no central bank policies or government rules are affecting things. In general, interest rates are affected by how much people save, supply of money, and how much people want to borrow, demand for money. Aggregate savings is how much people save, and aggregate borrowings is how much people borrow. When these two match, the interest rate is balanced. Option B fits the scenario. There is no government intervention. Option A can't be the answer. Option C, profit targets of banks might affect interest rates a little, but they're not the main thing that balances everything out in a perfect system. Option B means giving money to the projects or companies that will use it the best and create the most value. This is a main job of the financial system, to direct money where it can be most productive. Option A means making sure everyone who invests money always makes more money. But this isn't possible because investments can lose money too. The financial system doesn't guarantee profits. Option C means making sure every company can get money easily, no matter how big or small or how good their ideas are. But in reality, some companies are riskier or less profitable, so they don't always get equal access to funding. The financial system doesn't ensure this. Topic: Assets and Contracts. Alternative investment market includes things that are not traditional, like real estate, private equity, hedge funds, or commodities. The fund acquires and operates commercial office buildings. This is direct real estate ownership. Low correlation with publicly traded stocks and bonds is the hallmark characteristic of alternatives. Direct property ownership is illiquid, requires active management, and does not trade on public exchanges. Option A, traditional investment market includes stocks and bonds that are publicly traded and well known. Money market is for short-term, very safe investments like Treasury bills or certificates of deposit. Money market instruments are debt securities maturing in 1 year or less. Includes Treasury bills, repurchase agreements or repos, commercial paper, and certificates of deposit. The Treasury bills mature in 180 days, less than 1 year. The bank repurchase agreements last 1 week, also less than 1 year. Both are short-term, so they fit the definition of money market instruments. Capital market instruments are longer-term securities, like bonds, equities, with maturities typically more than 1 year. Intermediate term is not a formal market classification in the curriculum hierarchy. Equities are ownership rights in companies. It includes both common shares and preferred shares. Fixed income or debt securities are promises to repay borrowed money. It includes bonds, notes, commercial paper. Option C. Bonds are debt securities, not equity securities. The fund is not allowed to invest in debt securities. Option A is a stock, equity security, so the fund can invest in it. Option B is also an equity security. ETFs are pooled investment vehicles. Investors own fund shares, not direct ownership of underlying assets. ETF providers like BlackRock, Vanguard are financial intermediaries. They pool investor capital and manage portfolios. ETF prices fluctuate continuously during trading hours based on supply or demand, like stocks, not set by managers. ETF price stays near NAV via arbitrage by authorized participants. It's a market mechanism, not regulatory price controls. Option B matches the definitions of pooled investments and intermediaries. Option A is incorrect. ETF prices change constantly during trading day. Managers don't set intraday prices. Option C is incorrect. No regulatory price controls exist for ETFs. Arbitrage, not regulation, keeps price near NAV. All three options are actually traditional investments by strict definition. But the board must choose the least inappropriate option for an alternative allocation. Publicly traded REIT provides real estate exposure, an alternative asset class, with lower correlation to stocks or bonds than option B or C. Large cap stocks and corporate bonds are pure traditional exposures with high correlation to conventional portfolios. Alternative investments are direct ownership of illiquid real assets like Timberland, real estate properties, private equity, hedge funds, and commodities. Timberland is real estate, a physical asset, and considered an alternative investment. Traditional investments are publicly traded securities like stocks, bonds, and funds holding them. They are high liquidity, exchange traded. Government bonds are traditional fixed income investments, not alternatives. Corporate bonds are also traditional fixed income investments. Topic: Securities. Open-end mutual fund issues new shares when investors buy in. Buys back or redeems shares when investors sell. Share price equals net asset value or NAV at the end of the day. Closed-end fund issues a fixed number of shares, like a stock. Shares trade on an exchange, like stocks. Share price is set by supply and demand, may differ from NAV. Option B is correct. Open-end funds redeem daily at NAV. Closed-end funds don't redeem. Shares trade between investors. Option A. Closed-end funds trade on secondary market, supply and demand. Open-end funds redeem at NAV. Option C. Closed-end funds have fixed shares. Open-end funds continuously issue and redeem. The iShares Core S&P 500 ETF is designed to track the S&P 500 index, so it's a passively managed fund. When retail investors buy and sell shares on the NYSE, they're buying from and selling to other investors, not directly from iShares. So, these are secondary market transactions. Topic: Currencies, Commodities, and Real Assets. Financial securities, such as stocks or bonds, are homogeneous. One share is similar to another share. Easy valuation via active markets. Real assets, such as buildings, machinery, each has unique location, age, condition, specifications. No identical comparables. It requires appraisals, not market quotes. Option C is correct. Uniqueness or lack of standardization is the core reason valuation is difficult. No two properties are identical, so pricing relies on imperfect comparables. Option A. Real assets have low homogeneity, high uniqueness. Homogeneity would simplify valuation. Option B. Real assets have high, not low, maintenance needs, but this isn't the primary valuation complication. Topic: Contracts. Forward contracts, privately negotiated, customized agreements between two parties. No daily cash flows, settle only at maturity. No secondary market, extremely illiquid, difficult to exit before expiration. No clearinghouse, counterparty risk exists. Futures contracts, standardized, exchange traded. Daily marking to market, cash flows based on price changes. Liquid secondary market to exit positions. Clearinghouse guarantees performance. Option B is correct. Primary limitation of forwards. Customization creates illiquidity. No exchange exists to sell the contract to a third party if needs change. The farmer owns wheat she will sell, exposed to price declines. But she also wants to profit if prices rise. It needs a symmetric payoff, a protection without capping gains. Buy puts is correct. Put is the right to sell at strike price. If prices fall, exercise put, sell at higher strike. That's a protection. If prices rise, let put expire, sell at higher market price, keep upside. The only cost is premium paid. This achieves both objectives. Option A is incorrect. Selling futures locks in fixed price, protects against declines but eliminates all upside if prices rise. It fails her objective. Option C is incorrect. The right to buy wheat is useful for consumers, not producers. Does nothing to protect a seller against price declines. Forward contract is private bilateral agreement to buy or sell an asset at a fixed price on a specific future date. It's customized OTC, single settlement at maturity. Fixed price for future delivery is a classic forward contract structure. A put option gives the right to sell the underlying asset at the strike price, $75. At expiration, exercise if and only if the stock price is below the strike price, because you can sell at $75 when the market price is lower. The premium paid, $2.50, is a sunk cost. It does not affect the exercise decision, only whether the overall trade was profitable. Option A is correct exercise threshold. On equity swap, one leg is equity or index return. Its total return, including price changes plus dividends. The other leg is fixed rate, floating rate, or another equity return. Pension fund receives S&P 500 total return. Is equity or index exposure, not interest payments. Pension fund pays fixed 4% interest. This is fixed cash flow. No currency conversion involved. This eliminates currency swap. One leg is explicitly equity return, defines this as an equity swap. Option C is correct. Critical advantage of forwards. Both parties lock in a price with zero initial cash outlay, no premium, no margin requirement at inception. This makes forwards attractive for hedgers who want price certainty without upfront cost.